welcome to the Stockout. This is your show at FreightWaves for all things related to the CPG industry. I'm your host, Mike Baudendistel. I'm the head of intermodal solutions here at FreightWaves. So primarily deal with intermodal data and intermodal customers, the customers of that data, but also have an opportunity to talk about CPG industry and participate in the media side as well. And today on the Stockout, I'm going to give a little bit of a CPG earnings preview, talk a little bit about what I think those companies are going to be reporting the next few weeks. There's some of the earnings get kicked off this week in the CPG industry with Philip Morris, a good ESG name there, as well as Procter & Gamble on Friday. So I'll talk a little bit about what I'm expecting for the group as a whole. I think you're going to hit on a few big CPG themes as those companies report earnings. I'll also talk about a little bit about the commodities that go into CPG ingredients. Turns out they're not all going down. Sugar hitting a new high for about the past 11 years or so. Also talk a little bit about retail sales data. Would say the sales data there is kind of mixed. And then, as usual, we'll give a freight market update and talk a little bit about what's happening in the world of Sonar, our freight data product here at FreightWaves, and also what our editorial writers are writing about. So before I do that, if anyone is not already signed up for the Stockout newsletter, you can do that pretty easily at www.freightwaves.com/the Stockout. It's going to be the first one under newsletters and under supply chains. You can sign up for as many of those newsletters as you want. I think it's a pretty efficient way to understand what's happening in the CPG industry or other industries in about 800 words. They give us quite a bit of sort of latitude as far as what we write about on a week-to-week basis, just kind of whatever is interesting, whatever we think that we would want to know if we were in the shoes of the targeted audience, in this case, targeted audience being a CPG logistics division. So with that, I'll talk about the topic here, which is CPG Earnings Preview. And this company's reporting the next few weeks. I think I'm going to hit on a few different themes. I think theme number one is I think you'll see margin recovery for most CPGs. I mean, most of the CPGs, I really think their top priority is to improve their margins back to where they were in the pre-pandemic period. During the pandemic, they had all these additional cost pressures for the supply chain challenges, for not having enough labor. A lot of cases, the CPG volumes were way above the pre-pandemic levels because people stayed at home. That caused a lot of extra costs for things like contract manufacturing and expedited freight. So we're really just trying to get those margins back. And so it wasn't just the pandemic that caused that. It was also just the rising commodity costs, rising inflation. So during a period of rising inflation, the CPGs tend to have margins that shrink because their input costs rise faster than they can pass those costs on to retailers and consumers. And then when inflationary pressures ease, and it does seem like at least the rate of change has come down, quite a lot. That's usually when they get their margins back. So I think we're past the period of continual CPG margin contraction. I think we're in the period of CPG margin expansion. And I think Conagra's results last week, or maybe it was 2 weeks ago now, was a preview of what we'll see from the other CPG companies, where they showed a pretty significant margin improvement, and it was within about 30 basis points of where they were pre-pandemic levels. So I would expect that to be something that you see pretty consistent with the sort of when you compare the CPI index to the PPI index, where those lines came closer together. You see that period during 2020 and 2021, how those lines got closer together. Really, that was a period of margin contraction for most companies, most manufacturers, and that includes CPG companies certainly. And then in recent months, starting to see some evidence that those margins are expanding again as those lines grow further apart. So like last week, the CPI up 5% overall. Food at home up 8.5%. That's the one that's a little bit more directly relevant to the CPG industry. And the PPI, up 2.7 overall, so almost a little bit more than half of what the CPI was. And then the finished foods, which I think is pretty similar to the food at home category, up 6.7%. So CPI for food at home up 8.5, finished foods on the PPI up 6.7. So the implication is that companies in the food industry would see 180 basis points of a margin, at least, granted, gross margin expansion, because the consumer price is rising faster than producer prices at this point. So good news for companies, and I think we'll see that when the companies report. There's also some interesting information from Conagra last week on just sort of their cost structure, where they say that ingredients and materials make up 2/3 of their costs. And then some of the other things are still up pretty significantly as well, like labor. They say those are up mid to high single digits. And then the transportation and warehousing component is coming down, from a high level, as we have shown in the FreightWaves, data. Another theme I think that is really going to be, talked about during the CPG earnings season is that I think the companies will have fewer supply chain issues, and that'll lead to higher on-stock percentages. So you think of service levels from the CPG perspective, that means getting the products to the retailer or retail distribution center, wherever they need to go, sort of on time and in full to satisfy those requirements. I think those percentages will rise, and I think you'll hear fewer supply chain issues, or at least companies say that their supply chain issues are less than they were a few quarters ago. Just from all of the sort of the CPG news feeds that I'm on, I'm seeing a lot fewer of those issues. It's actually made it a little bit harder to find topics to write about for the stock out, because there's been fewer problems. But that has the impact on CPG companies in a couple of different ways. One of those ways is they'll have a little bit better volume because those products will be to retailers and be on shelves. And then you also have some lower associated costs, because when there are supply chain issues, that causes incremental costs, things like expedited freight, having to get ingredients from another source, et cetera. What makes up for that partially is you might see a little bit of increase in marketing spend, because as those companies had those supply chain issues during the pandemic, a lot of them cut back on marketing, figuring, well, there's no reason to market those products that are not going to be on shelves. So maybe they give back a little bit of that, but I wouldn't think that it would make up for the whole difference. Sort of theme number 3 is I think elasticities will continue to be muted. So elasticity is something CPG companies care a lot about, particularly when price levels are rising as much as they have been. So the industry-wide, the elasticity has been about a 0.3 thereabouts, which means that for every 100 basis points that these companies take the prices up, that the consumers see, it's about 30 basis point decline in volume. And so that's been no worse than historical levels. And I think most of the CPG companies have been pretty satisfied with that elasticity. You've heard companies use terms like muted elasticity, and I think that will continue this quarter as the companies report. I think if we would have seen a huge uptick in elasticity, we probably would have seen it already, with the caveat that the consumer is still under a lot of pressure, which is something that I'll talk about a little bit later in the show when I go through the retail sales level sales data. But for the most part, I think companies will talk about elasticity continuing to be under control. Another theme here is I think one risk that investors are concerned about is that the brands are going to use promotions too heavily. That's come up on some analyst calls I've seen in some analyst reports, and sort of the theory there that's a bearish argument is that the CPG companies during the pandemic and during this period of rising price levels, one of the ways they increased prices without formally increasing prices was to have fewer promotions, so fewer buy one get one free, those type of things, and that's was able to maybe preserve margins just a little bit. And the CPG items went from being about 18% of the total items being under some kind of promotion like that to about 12%, which is a historic low. And so the idea is these companies will fight each other over volume and have more of those promotions, and that the companies will essentially give away a lot of this margin, potential margin improvement that they should be seeing. And so that's the one theory that's out there. I don't buy it too much, because I think the CPG companies are very focused on margins. I don't think that they're going to trip over themselves to get volume at the expense of margins. That's not the impression that that I get. I mean, so many of the CPG companies are reducing the number of SKUs in order to preserve margins, and that's something that historically is something that you could trade sales in exchange for margin, because some consumers, in theory, their SKU disappears, they go to different company, different company's product. But so many of the CPG companies feel like, well, if they eliminate a low performing SKU, that consumers are just going to gravitate to a different SKU that company manufactures. You hear that from companies like Nestle and Smucker that have a lot of products at various price points. Move on to topic number two. So I would say on balance, pretty positive on the company's reporting earnings next couple weeks. I think on balance, they'll be pretty positive for all those reasons I just outlined. I'll move on to topic number two, which is sugar prices are surging. This chart that's on the screen goes back to the middle of 2003. So let's call it a 20-year chart. And the sugar prices now are at the highest they've been in about 11 years, since about the beginning of 2012. And a few reasons for that. There's been, I guess, difficult growing conditions in Asia, rated in Thailand, and also these high fertilizer prices that were really sort of the result of the Ukraine war in Ukraine. And even though Ukraine really doesn't produce sugar itself that would move the global commodity markets, they do produce a lot of the fertilizer that would normally get exported to Asia that would be used in the sugar production. So that is working its way into those sugar prices. So this is kind of one example of commodity that's going the other way. Some other examples are orange juice, frozen concentrated orange juice up 37% year to date. So that's another commodity that's increasing. Supposedly that's the worst crop in Florida in 86 years. So a 23% decline in production this from last year, according to the USDA. And then coffee prices are also rising. So on this show, I talk a lot about sort of what's happening with commodity prices overall, and a lot of the real big ones are have declined. Things like corn, wheat, soybeans, those well off their highs. Those big deal for a lot of CPG companies. But then you have some of these others that are rising, which depending on which CPG company we're talking about, could have a little bit of a mixed bag in terms of what their cost structure sure is. So really, you have to look at the specific commodities that pertain to your company. Move on to topic number three, is that grocery sales have been weak in March, and there's some interesting data here from I guess this is the U.S. Census Bureau. So the U.S. Census Bureau puts out this chart, if you can see the screen, and the one that probably pertains the most directly to CPG is the white box, which is excludes retail sales, excludes auto, and so you see in January how it's still up about 2%. And the other thing to mention here is that these are adjusted for seasonality, but not adjusted for price changes. So these not adjusted for inflation, and so sort of a flat number like you get in February really does represent it's kind of a flat dollar number, but a reduction in what consumers are getting for those dollars. And you do see sort of the trend of a decline on a seasonally adjusted basis. Part of that is likely that January, typically a weak month for these type of sales, so they get an adjustment upward. March is usually better, so you get an adjustment downward. But still, I think a little bit concerning that March declining on the retail sale fell 1.2% month over month and down 1.5% year over year. So that did look worse than February, which is down 0.2% month over month, and up 5.9% year over year. So it does seem like there's a little bit of additional pressure, on the consumer, at least on a seasonally adjusted basis. I think one bright spot there was e-commerce in March, up 1.9% from February and up 12.3% from a year ago. So even though you do hear a lot about retrenchment in e-commerce, I think there's still data suggests that it's still a growing industry. I'll move on to topic number 4 here, which is a freight market update. And I'll look at this from a few different ways. There's a good article that Todd Maiden just published. This is freight shipments and costs sag in March. So he wrote up data that was put out by Cass, Cass Freight, and Cass reports a 12% decline in expenditures, and then have this grid that I think was interesting from his article, if we can bring that up. So this is in March 2022. This is from Cass Information Systems. So this is a company that processes freight payments. And what is interesting here is you look at the column that's the second to the right, shipments down 1% month over month. That's in March from February. Now that's unusual because March is usually a stronger month than February. That's why on the column to the far right, on a seasonally adjusted basis, it's down 3.8%. And that's something that you always have to keep in mind when you analyze freight data, is just how seasonal it is. And March usually is kind of the make or break month for carriers in the first quarter. Usually to start to see some improving freight conditions. And even though maybe January into February was maybe held up a little bit better than expectations, just given how soft the fall was, really haven't seen that haven't seen much improvement in March. The other thing that is interesting from looking at this chart is when you combine a couple of these different indexes. So that first one, if you're looking at the column on the left, the year-over-year change in shipments down 4% in March. So let's say volume down 4% in March, expenditures down 12%. Now those expenditures are all in and would include fuel. And so the implication is that a CPG company or another shipper, had an 8% lower all-in costs in the month of in the month of March, and so that's kind of a bogey that I would use if I was a CPG company. Look at this, I would look at my own costs all in and say, how does mine compare to that benchmark of about 8% lower per shipment, and then you have also that index of the truckload, line haul index down 9.6%. Believe that strips out both fuel and accessorials. Analyzing fuel month over month in March is a little tricky because March of last year, the diesel prices were really running. So there could be, depending on exactly the timing there, the timing could be a little bit off. When exactly that's being calculated. But all things considered, it shows some weakness in freight market rates, and so that's something that go back and read that article. And then another thing that I would highlight, while we're on the topic of the freight market, is there's going to be a State of Freight webinar later this week, and these have been really good. I've listened to the past few, and it's just a really efficient way in 1 hour to hear from Craig Fuller, our founder and CEO, Zach Strickland, who I think knows the data that we have in FreightWaves better than anyone, and Adam Josephson, who has a background similar to mine as a sell-side stock analyst, and his specialty is cardboard boxes and other packaging, which is remarkably closely correlated and tied with the freight transportation market. And so he brings an interesting perspective on what's happening in the freight markets as well. So that is well worth your time. I think all you have to do to sign up for that is go to freightwaves.com, go to events, and it's one of the virtual events. Move on to a couple of Sonar charts that stand out to me. Want to bring up, this is domestic intermodal volume. So just looking at 53-foot containers. And so what's unique about this data series is that we're limiting it to just the domestic segment. If you look at the AAR data that comes out every week, every Wednesday, I think most people probably get that data that conflates the domestic and international intermodal volume, and we're also able to look at it on a lane by lane basis. But so this is going to be the JB Hunt's market, Hub Group's market, Schneider's market, all those companies that participate in the domestic intermodal market that own 53-foot containers. This is what they care about, and really what this shows is been a lot of weakness in the domestic intermodal segment as well this year. Really the domestic intermodal segment had been holding up pretty well relative to the international segment throughout last year, as well as most other transportation modes, and starting to see that crack a little bit this year, where now those volumes are down double digits and sort of took a pretty significant step down in March and into April. So JB Hunt reports after the close today, which is Monday, and so we'll see if they're any less optimistic on the market. I think one silver lining for the domestic intermodal companies is that there seems to be more container balance in the market, because most of the lanes that have been weak have been a lot of these outbound LA lanes, sort of the primary ones being LA to Chicago, LA to Dallas, and LA to Atlanta. Those are all down, well into the double digits, and that's really just been driven by lower import volumes, particularly lower import volumes into the ports of LA and Long Beach. Seems like with inventory levels still a little high in a lot of cases, there's less need for speed and getting those products to market quickly, which is normally what you would do. It gives an advantage to the LA market because you can move that quickly on what's called the land bridge versus an all-water route to the East Coast. So it'll be interesting to see what JB Hunt says. Also interested to see what they say about pricing. I have an intermodal chart on pricing that we can bring up, and so this is from data that comes from a company that processes transactions, and each of those lines represents a year, with 2023 being the white line. And you see that last year 2022 was in green, and that actually held up pretty well sort of throughout the year. But I think a large part of that was as a result of intermodal contracts repricing, more of them repricing on an annual basis under annual contracts. And so, like, if you compared that to what happened in the dry van truckload market, more of those were repriced quarterly. And so you would have seen, if you did the equivalent chart for dry van, you saw rates step down kind of each quarter, last year. But in the intermodal space, mostly annual contracts, mostly priced in the first part of the year. So you do see that down pretty significantly, year over year right now. I think when I look at the last data point, it's down kind of mid-teens and in line with 2021 levels. Should mention that it is down from a high level. You look at 2019 is in purple, 2020 is in 2019 is in blue, 2020 is in purple. They did take a step up during the pandemic of all that tightness that happened in the middle of 2020, and then as those contracts got repriced in early 2021 and early 2022. Those were both up double-digit percentages. And so now it's kind of going back down to where it was, let's say, 2021 levels, but kind of the trajectory seems to suggest that it's going to maybe go lower than that. I don't know that we're going to get all the way back to pre-pandemic levels on that, because the carriers' costs have certainly risen during that time frame. But this is something to watch pretty closely, is the trajectory of intermodal contract rates. So that's really what I wanted to go over today. We'll look to write up, what happens with JB Hunt on Monday night, and then later in the week we have CSX and Union Pacific. So I'll try to speak about those on People Speaking Rail, which I host on Thursday at 3 p.m. Do that with Joanna Marsh, who is our editorial, writer on the railroad, industry. Hopefully, she's able to join me. I guess she had an issue with her house, kind of an act of God, if you will. The tree fell on her house and did quite a lot of damage. And so I think she said she had to take everything out of her son's house, and going to have some 100-foot crane pull the tree off of her house. So she's dealing with a lot. Hopefully we can still do the show together on Thursday. If not, I can probably handle it on my own, but won't have her insights. I think with the key thing for the rails right now, at least from my perspective, is how are they going to pass on the higher costs that they're incurring. Keep in mind, all the railroad workers got a big raise last year with the contract negotiations. So that's a big issue. And then what's also a big issue is the service levels, which there are still seem to be a lot of complaints about railroad service issues from the American Chemistry Council and other shipper groups. Is interesting that some of the rail CEOs are starting to maybe make comments to back off of PSR. You probably saw the comment from CSX, a CEO that says, well, maybe the PSR took it a little bit too far. So, kind of reading the room and saying, well, PSR went from being the way to market the shares to Wall Street to being something that you're trying to walk back to not be regulated too heavily. So, with that, see people on Thursday for People Speaking Rail, and hope everyone has a great day.